Hello, everyone. This is Ted Bauman here, editor of the Bauman Daily. Before I start today's video, I want to just tell you that I'm going to be appearing on a program called Money Talks on July 28th. I'm going to be speaking at 2:45. I'm going to be giving a presentation on investing in a no fundamentals environment. In other words, investing in an environment where really fundamentals don't matter a lot to a lot of investors. It's changing, but it's still a big challenge. So if you'd like to attend that presentation, you can click on the link in the box below, and that will take you to registration. Also, if you want to subscribe to the Bauman Letter, you can click on the link above my left shoulder or in the box below to join. Today I want to talk again about inflation, but I want to do so for a very different reason. I've been talking about inflation lately, expressing my skepticism that it's actually going to be a big issue going forward. There are a lot of I think fundamental technical reasons to believe that inflation is not likely to be as bad as a lot of people think. And in fact, the market seems to agree with me. If you look at the bond market, as I talked last week, bond prices have risen, which has caused yields to fall, which tells me that the market is not expecting a lot of inflation. But inflation does have a history, and it does have a tremendous impact on anybody who is not invested in the stock market. So let's look at the history of inflation. Now, as an economic historian, I saw graphs like this when I was at university, but here's one that goes back to the mid-14th century. It shows you the nominal rate of interest on various kinds of lendings. Back in the 14th century, that would have been lendings to kings and other royal houses. Over time, it becomes lending to governments. But there are two things to point out. One is definitely that the slope of the line decreases. So the rate of interest charge on lending, which is obviously sensitive to inflation, has fallen really for centuries. So the fall that we have seen more recently, we're way over there on the right-hand side. This only goes to 2018, of course. But the recent fall is part of a much, much longer trend. The second thing to point out is that we do get spikes. You do get spikes in inflation, or rather in interest rates, that are caused by short-term factors. There's a big spike in the early 19th century, for example, which was due to the Napoleonic Wars. We then saw a big spike in the early 1970s, which, as we know, was caused by the Arab oil embargoes and by various mechanisms, particularly in the U.S. economy, which tended to increase inflation expectations. Now, what does that mean for real yields over time? That's really the topic today, is what about real yields? So if you're buying bonds, for example, and you incorporate inflation into your projections, what are you getting? Well, here's the same information plotted. You've got the nominal rate of basically interest, then you've got inflation, which is the orange line, and then you've got the real rate that results from the two. So basically, when you take the nominal rate, subtract inflation, you get a real rate of return. Well, over time, it's fallen. In the 1300s, you were getting a real rate of return on your lending of about 5%. It increased over a century to about 10%, but it's fallen now to the point where really, honestly, the yield on any kind of bond, and this is an aggregation of all kinds of bonds, is pretty poor. I mean, basically, you're not getting much. And that's why people talk about TINA. They say, well, with interest rates like that, there's no alternative to the stock market. Well, the big issue is what part of the stock market, which I'm going to come to in a moment. Now, here is the 10-year Treasury yield going back really to the 1960s. And you can see again that spike that we saw in the previous chart in the 1970s, again caused by the oil price shock, but also by things like the tail end of the Vietnam War, by union cost of living increases, and all kinds of things. But look how much it's fallen. And I showed this chart last week because I wanted to illustrate that regardless of fears about interest rates and inflation, look how low we are. I mean, we're basically down around that 1.5%. You take away inflation, you're probably getting a negative yield at this point. But it's extraordinarily low by historical standards, even over the last half century. Now, here is a chart that shows a junk bond ETF, which basically reflects the performance of very high yield bonds going back. This is a 10-year chart. It fell pretty significantly into 2016. It then rose up to, kind of a steady state for a couple of years, fell again, in 2018 when there were fears about interest rates increases, because of course if the yield on Treasury bonds increases, that makes the necessary yield on junk bonds have to increase to compensate for the additional risk. Then we see another period of sideways movement for a year, then COVID, and we're right back basically to where we are roughly back in mid-2016. And again, this level of return, which is coming at a much, much higher risk than Treasury bonds, isn't spectacular. So even if you were to put everything into corporate bonds, which would be very inadvisable, I would tell you, given the risk there, you still wouldn't make a lot of money. Now, here's another chart that shows nominal and 10-year Treasury yields, again, going back to the early 60s. So this is part of what we've already seen. This shows the nominal yields on 10-year Treasury bonds, less inflation, that's the blue line, and then your real yield. So where we are right now, this is as of June 30, 2021, is that your real yield is about negative 2.35%. So you are losing money if you have got your money stocked into 10-year Treasury yields. Now here is another way of looking at that. This is the impact on fixed income returns if yields were to fall to zero. And this shows that over time, the price return and the coupon return has also fallen to extremely low rates. So basically, the ideal, or the idea that you can keep 60% of your portfolio in stocks and 40% in bonds is right out the window. Now, again, here's another way of looking at that. This shows essentially the 15-year range of different types of fixed income instruments, U.S. Treasuries, municipals, mortgage-backed securities, high yields, leverage loans, etc. It shows the 15-year median return on those instruments, and it shows the current price. And in every case, except for emerging market debt, we are below the 15-year median. So right now, the fixed income universe is not a good place to have your money. So bonds are not going to give you anything. Now, what does that mean for somebody who is risk averse and doesn't want to put their money into the bond market? Well, you might think of the bank savings, but look at this chart. This shows the income earned on a $100,000 savings account going back to the early 90s. Now, the red bar shows you the income that you would need from that $100,000 to beat inflation. So if you wanted to earn an interest rate that would beat inflation, that column needs to be higher than that bar. It hasn't been since 2007. So essentially, since the great financial crisis, keeping money in the bank is essentially akin to burning it, throwing it away, flushing down the toilet, whatever you want to call it. So essentially, keeping money in the bank is not a good thing to do. Now, right now, if you take the average U.S. Personal savings account, it'll return about $100 or 0.1% interest for every $100,000 invested. That is well below the $1,283 that you would need to beat expected inflation. So how do we deal with this? I mean, what's the alternative to putting money into fixed income if you are risk averse? And I want to stress this because I'm not talking here about those of you out there who are interested in investing in Bitcoin and high growth stocks, and maybe you're a Robinhood trader who's made a lot of money on meme stocks. This is not about that. I'm talking to everybody who is interested in earning a return that will beat inflation under the current environment, because that's really something that is becoming a big issue. Well, here is a chart that shows since the beginning of the year the Russell 2000, which is fundamentally the place where a lot of people go to look for high return stocks. It's the kind of place where you'd find companies like Zoom or AMC or GameStop or other companies that have yielded a lot of returns on a price basis for people this year. Well, they rose at the beginning of the year, but they have fallen substantially. But look at what's on top. That is the SPYD, the portfolio, the SPDR portfolio S&P 500 high dividend ETF. This includes companies that earn high dividends. Now, at one point, it was beating the market by nearly 15 percentage points. It's pulled back a bit since then because everything has pulled back. But the key thing here is that it has consistently beat the more risky part of the market, represented by the Russell 2000, all this year. Now, here's the punchline for the whole exercise, folks. This is a chart that shows the performance of my endless income portfolio in my Bauman Letter since the beginning of the year, again, since the Russell, against the Russell 2000. So in other words, if you're not looking to invest in high risk stocks, if you're not looking to invest in, highly volatile stocks with high betas, stocks that may go up and down a lot. If you're looking to make money from dividends, if you're looking for safety, but you're also looking to be your savings account and your bond, endless income is the place for you. Look, our time-weighted rate of return this year is 19% versus only less than 3% for the Russell 2000. Now, I know what you're probably going to say, but you're going to say, Ted, but isn't the market as a whole up about the same? Well, it is, but if you look at the thing that's driving the S&P 500, something I said to my Bauman Letter subscribers this week, it's about 5 companies that have driven the gains in the S&P 500 since May. It's only been driven by those top companies. We've seen market breadth decline. We've seen the number of stocks that are trading below their 50-day moving average increase dramatically during that period. The key thing here is that if you invest in strong companies with strong dividends, strong balance sheets, quality earnings, then you're going to beat the market, particularly the volatile part of the market, but you're also going to beat keeping it in a savings account. You're going to beat the pants off of keeping it in a 10-year Treasury yield, and you're going to beat pretty much every other kind of fixed income item that you can see. Now, the maximum drawdowns in those blue lines, you can see by the depth of those drawdowns, is nowhere near as extreme as those of the market as a whole, rather the Russell 2000. That indicates that this is a much more stable portfolio that generates much better returns than investing in the riskier parts of the stock market or in the fixed income market pretty much anywhere. So that's my message for you today. If that's what you're looking for, and I've had a couple people contact me and say, hey, Ted, the market feels overbought to me, prices feel excessive, I'm worried about volatility, I'm worried about things pulling the rug out from under all these speculative stocks, where should I go? Endless income, folks. That's where you should go, and you can get there through the Bauman Letter. This is Ted Bauman signing off. I'll talk to you again next week.